Hello, everyone, and welcome to another episode of the Perfect RIA podcast. I'm your host, Matthew Jarvis, and with me today we have a special guest, Harris Baltch from Dynasty Partners. Your title is Director of M&A and Capital, but Harris and I have had the opportunity to talk many times over the last several months. He was introduced to me by Michael Henley, who's a great advisor in his own right, has also been on this podcast. But we're excited to have Harris on the line to talk about what he's seen, talk about what Dynasty has seen as a major player in the industry, and hopefully, as always, deliver massive value to you, our listeners. So with that, Harris, glad to have you on the show.
Thanks, Matt. Really pleased to be here, and congratulations to you on building a very successful RIA, and the listenership that you've created with the Perfect RIA has been absolutely incredible. So very delighted to be here and speaking with you. Thanks for having me.
Oh yeah, thank you. It's been a lot of fun. Well, Harris, if you would, let's start by giving our listeners a bit of background about you, how you got into the M&A space, specifically in our M&A space, the advisory space, what you're doing at Dynasty. Give us a little background.
Yeah, it was definitely feels like a long journey home, into the industry, Matt. I mean, I started off my career as an investment banker at UBS. I always covered the asset and wealth management space broadly, but as I was building out the wealth management practice at UBS, I called on the industry. One of those firms that I called on was Dynasty Partners. And the business has been up to some really interesting things in its short 12-year life, which I'm happy to get into.
Has it only been 12 years? Wow,
only 12 years, and so the business has grown up considerably. A lot of what we do is out of accommodation to our clients and our clients' clients, and so I was invited to come in and build out an M&A team as an accommodation, really to support our clients and help them grow, and that role has evolved considerably in the short time that I've been at Dynasty, which is about 2.5 years.
Okay.
We manage a capital program where we make investments into RIAs. So happy to talk about, whatever you'd like, Matt. The M&A space continues to be highly disruptive. Lots going on, and there will continue to be a lot going on going forward. There's a lot of market volatility, in the space. We could certainly talk about how that plays into M&A. Happy to talk about, or at least comment on the interest rate environment and how that plays into M&A, which is, it's an interesting time for all of us. Some of the second generation advisors that are looking to buy into practices are certainly dealing with unexpected rate hikes that have implications on their affordability to the extent they were looking to take on some personal leverage to buy in. But happy to really take the conversation wherever you'd like, Matt. So, back to you.
Yeah, no, that'd be great. And I'm excited to have you on. There's always a lot of talk, and always has been a lot of talk in the industry. I remember, so I've now been in the industry just shy of 20 years. And I remember when I first started, they were talking about 20 years ago, so this was in like 2003, that this big wave of retirements was going to come in the industry, and that all of the senior advisors were all going to retire to the junior advisors. And I'm still hearing that same message today, Harris. It feels like we're talking about this big wave of retirements that don't seem to have happened, but it has to happen eventually. And how do you think, I'm going all over the place here, how do you think these changes in interest rates are going to impact that? Like an advisor who's been holding out for 20 years to sell, or a junior that's been holding out for 10 years to buy, what's going on now?
Well, there's a lot to unpack there, Matt.
Yeah.
With where the industry is dealing with tremendous, headwinds right now with an aging advisor base. There are more advisors that are looking to retire out of the industry over the next 10 years than there are going to be new advisors that are coming in, right?
Oh, for sure.
And so you kind of have this very natural overhang. And with the introduction of all different types of capital sources into the space, it's been very enticing for advisors that own their own practice to consider a monetization event. When you layer on top of that the introduction of private equity into the space, so lots of different capital choices, higher interest rates, and a very volatile market, there is a natural retirement point in everybody's career. And so for advisors who are thinking about a monetization event, especially in this volatile time, might feel, a little bit of a sense of urgency. in terms of exploring, different types of opportunities that are out there. And the reality is, there are a lot of opportunities out there right now. There are integrators, there are aggregators, there are other RIAs, there are banks, there are insurance companies. There are firms that only want to make a minority investment in firms, and there are different types of transaction structures and capital options really available for the full group. The one issue that I'd say we see that does bump up quite a bit is really, and you mentioned this, the second generation advisor, yes. Right? It's one thing for a first generation advisor to monetize their life's work, but they're doing it at the cost of a second generation advisor that may not be able to necessarily buy in or take advantage of the same monetization event. And so that plays in really a couple of different ways, because with valuations kind of plateauing to where they are right now, and a rising interest rate environment, Matt, what you're seeing is that the bites of the apple that some of the second gen advisors are trying to take are getting smaller and smaller. Firms that are trying to accommodate internal succession might have slightly depressed valuation multiples internally to accommodate succession, but it doesn't change the fact that unless the key principal is willing to guarantee debt, the business is willing to backstop it in light of some type of succession event, it's going to be harder and harder to get those deals done. And even if they do, what you're seeing is it's just not enough, right? You might have a second gen advisor that wants to buy 5% or 10%, or a group of mid management who wants to buy 20%. For an aging advisor who's 65 on the verge of 70, that's not enough for them to fully monetize, and so there are a lot of different external third party options out there today as well.
No, I appreciate that background, and I think what stands out to me, and feel free to jump here in a second, with these G2 or Generation 2, like when you've got an internal succession, and I get that the senior advisor, we're say senior and junior for lack of a better term, says, hey, boy, I'd love to sell to my junior, but my practice just got valued at $12 million, and my junior's making $200,000 a year. Right? That's just this like enormous gap. Is that where, as you mentioned, like, hey, that might be a good time to talk to M&A, to talk to these other resources and say, great, we'll sell whatever interest we can to the junior, but this third party, this integrator, this aggregator, whomever, like, they can provide the difference. And I think we've seen that on some really big deals. Merriman Financial, which is in my backyard in Seattle, they did that. When Paul Merriman, the founder, retired, they were at a couple $1 billion in assets. There was just no way that some junior could buy him out. And so they brought in external funding to do that transition.
Yeah. What we'll see is that, to the extent the senior advisor really wants a junior advisor to buy in, you'll exhaust a lot of different options, right? Yeah. One of the most common ways you see things getting done internally, if there is no kind of external leverage that's put on the advisor and on the business, is sometimes you'll just have an internal seller note, which is pretty common. That way you don't really see meaningful cash change hands, at least not initially. And in a rising rate environment externally, you can set an arm's length seller note that's below market, which really accommodates succession and puts cash flow in the pockets of the senior advisor over time. But to your point, if that's not enough, then there's typically some type of external event. And look, there's certainly a lot of different buyers out there, and so for senior advisors that are contemplating some type of event and don't think that they can do it externally, that's where our team goes and gets involved. I think 90% of what we do is help educate, right? We want to make sure that we're educating CEOs around the buyer landscape, how they differentiate, what their deal terms look like, and what the merits are of each type of firm, because each firm has a very different path of growth and very different capital structure in and of themselves. A lot of them are private, right? A lot of them have lots of different types of capital backing in order to support growth, and it's important that CEOs are informed and educated on what those are and what the implications will be for their clients if they were to move forward with a deal. We've seen a lot of different, deals gone wild over the past year, where you have advisors who think they know what they're getting themselves into, maybe sign a period of exclusivity, they back out. We've seen deals, and this has been, in the press, where deals go ahead and they get announced, right? And it ends up being, not all of the advisors really wanted to sign up for that type of transaction. And you had senior management who was thinking about it in a very different way, and that actually creates destructive value, right? Because deals get announced, they don't get closed, advisors and clients go elsewhere, and there's a lot of dirt to really mop up.
Something that stands out to me in all this, Harris, if we're in, and I know we're kind of highlighting on multi-generational firms, whether that's family or not family, but if you're on either side of a multi-generational firm, right, you're a senior advisor and you're saying, hey, someday I'm going to want to sell this, or you're a junior advisor saying, hey, someday I hope to be able to buy this, you've got to start now really going, you got to reach out to Harris, reach out to Live Oak, reach out to whomever and say, like, just pencil on paper, like, how could we make this work? Because the longer you wait, the less likely it is to work. And I think, and Harris, I'd be curious your thoughts. I meet a lot of advisors. They sort of have this imagination like, hey, someday magically we'll come up with $10 million and I'll buy Dave out overnight and then one day he'll retire. And there's already a ton of moving pieces. Some of those that you mentioned, like, hey, there's the clients and there's the team members and the partners. But if you don't have at least pen to paper on what could this deal possibly look like, I think you're going to have a hard time getting it executed when the time comes.
Yeah, I think that's right. I mean, you need to be prepared, Matt. And part of that preparation means having very transparent and direct conversations, between senior and junior advisors. If you're a senior advisor and you feel like you have a deep enough bench and they've been knocking at your door, you want to invite them in and allow them to participate in the enterprise value growth of the firm. Things need to be done now in order to prepare for later, right? The operating agreement, for example, needs to be looked at and to see how it accommodates succession, because, a lot of times we see advisors who want to, undergo some internal succession event. They haven't really even thought about, what the implications are in their operating agreement. So you need to, hire a good lawyer and make sure that you're thinking appropriately about valuation. What's the going concern value of the business today? How much would it be worth if I tried to sell it externally? And what would be the appropriate discount that I would allow for my junior team who is coming up the curve to participate in the firm's growth. And so you need to take care of those things now. It's good governance, right, to know what you're worth every year. It's even more important to share that type of transparency with the rest of your firm, particularly those that you want to earmark to buy in, right? And so I encourage anyone who's thinking about doing a transformative event, either for yourself or for the junior talent, to start early and be prepared, right? Because if you're not prepared, then you're going to have no control around what the outcome is going to look like. And at least if you're prepared, you can have a plan A and a plan B, and more importantly, you have you can line up a team of advisors that can help you, right?
Yeah.
Because when you're
sure.
going through succession, it's important to have a qualified investment banker. You want to have good legal counsel. You want to have good tax counsel, right? And to the extent you're looking externally for funding, right, you want to know what the landscape looks like, both on the debt side as well as on the equity side.
Yeah, something I want to call out for our listeners real quick. If you were one of our listeners, and we just passed 1 million downloads, so really thanks to our nation for that. If you're a listener who's in a multi-generational spot, you're thinking, oh, this is really good stuff. But if you're a listener who says, hey, I'm 20 years out, this isn't really applicable for me, I would say, hang on, let's take a step back. It's applicable for everyone in as much as there could always be a scenario where you have to sell. Let's say you have a debilitating injury where you can no longer practice. If you pass away, the SEC is really starting to clamp down on advisors not having succession agreements. And if your succession agreement is, hey, Dave, my buddy across town is going to buy my practice, cool. How's Dave going to fund that thing? Unless Dave's got a couple $1 million sitting in a bank account that's ready to buy this, which that's not realistic. To go through anyway, what I'm getting to is to go through this exercise, I think is critical at almost any stage of the practice, especially once you've hit $1 million or north of revenue. Your practice is now too big that someone, just the random guy, could write a check for. You're going to have to get professional funding or professional help for that.
Matt, I'm gonna put you on the spot for a moment.
Oh, please. Yeah.
Because I know you're a direct beneficiary of Jarvis Financial, right? You acquired the business, from your dad. I mean, I think it would be really helpful, for maybe some of your listeners to hear how you were able to accomplish a very successful succession plan, because that could serve as a really nice blueprint for some of your listeners.
Yeah, no, that would be great. I was thinking about that as we were chatting. So back in 2012, family businesses are always complicated, right? So we're going to set aside the family dynamics. Back in 2012, it was time for me to buy dad out for reasons I'll leave for another day. So we had an independent valuation done by, I believe it was FP Transitions at that time, because I have 6 siblings. And Harris, last thing I wanted was one of the other siblings to come back and say that you had gotten a sweetheart deal for mom and dad. So we had an independent valuation. I want to say round numbers, that valuation came in at around $1 million. This was 10 years ago, so I'm trying to remember. We externally financed half of that. We were able to get an SBA loan, which took a lot of work because a practice is all blue sky, right? Like there's no inventory, there's no anything. And then mom and dad financed the rest of it on a note that matched the terms of the SBA. The one interesting provision they put in was that they had the discretion to suspend payments. So they were nervous that, hey, those payments could cripple the business. Like if the markets went down and cash flow dried up. So there was a provision that they had at their discretion could suspend payments and tack those onto the back end of the loan. Thankfully, that was never needed, but it did give me a lot of breathing room. Also gave the bank a lot of breathing room because the bank didn't want to see their payments get cut off either.
Well, it's really comforting to hear even 10 years ago. I mean, some of the things that you and I are talking about right now were, in fact, things that you and your dad practiced in order to, affect what has been a very successful transition and successful business.
Yeah. And there's a lot more resources now, right? Live Oak Bank is there. Dynasty, the things you guys are doing, right? 10 years ago, Dynasty was just getting rolling. And now you have a whole M&A team led by really qualified people. So there's a lot of resources, and we were able to make that work. Not everybody can do that, right? Not everybody has a seller who's willing to carry a note. There's obviously a lot of trust that goes on. Probably trust bordering on like blind optimism, right? If you're carrying a 5-year note or a 10-year note, in fact, actually, I guess this might be TMI. I'm actually just making the last payments on that note to mom and dad right now. This year, right? So 10 years later, that's a lot of blind optimism to say, hey, listen, I think this practice I'm selling to is 10 years later is going to be able to make those payments. Yeah,
that's great. I mean, we've heard all sorts of stories out there, some good, some bad, but at the end of the day, the second generation really needs to want it. So I got to imagine if you didn't really feel strongly about the business, right? You would have backed away, and your dad would have looked externally for a sale at some point in time. But I mean, you bet on yourself. You wanted to become an entrepreneur. You are an entrepreneur at heart with all the wonderful businesses that you've built out.
Yeah.
And so you knew, right, 10 years ago that this was a risk that you were willing to take.
Yeah, 10 years ago might have been blind optimism on my part too, Harris. Me 10 years ago is not. I still had hair at that point. It's not me of today. But yeah, we were able to make that work. Again, anybody who's in a family business knows that the dynamics are complex, but anybody in a multi-generational practice knows that those dynamics are complex. And as we've kind of been talking, those aren't going to work themselves out magically.
Yeah.
Well, Harris, I really appreciate this discussion. I think we could go on for hours on this. What are some action items that you would give to our listeners, things that you could say, hey, no matter where you're at, or maybe if specific scenarios come to mind, what are action items that people should be thinking of?
I think on the buy, I'd split this up between, if you're listening and you're on the buy side, you're a net buyer, what are you thinking about? If you're on the sell side, what should be your approach? I mean, I think on the buy side, it's important to just be very disciplined with your buying behavior, right? Start small, because it's easy to make a small mistake before you make a big mistake, right? Because it has real implications on your business and cash flow. So, make sure that you're thinking through your decision steps, that you're aligned with, if you're not financing deals internally, with a capital partner that you trust, that can create a repeatable process for you, because there are a lot of different types of capital partners out there. On the sell side, it's important to be incredibly prepared. You want to make sure that you're engaging with a firm that can provide sound investment banking advice, that interacts regularly with the sell side community. and that you have a really strong equity story. I mean, right now, I'd say more so now than ever, just given the aging advisor base, you are seeing more and more deals come to market. You really need to differentiate yourself, have a strong equity story, right? And that you are aligning your business for success with your new owner, right? I think a lot of advisors kind of, decide to jump in because valuations are hot and they want to, take advantage of that. But if you can't deliver a successful transition and the client experience isn't preserved or enhanced as a result of the deal, it's going to be a tremendous amount of value destruction, because so much of this business is really based on the holy grail of the relationship between the advisor and the end client. So be prepared. Have lots of conversations before you act, and align yourself with people that you trust.
Boy, I love that, right? So it's almost like it's this trifecta of, obviously you've got to have the funding, right? The deal has to happen. There's the legal, which we alluded to earlier. And then, as you mentioned, I mean, nothing else is really going to matter if you can't transfer that relationship, if that credibility, that continuation isn't in place.
That's right.
Harris, one last question for you. At what
Sure.
stage does it make sense for someone to reach out to you? I know before you and I got introduced, I thought, well, Dynasty M&A, this is if I have a multi-billion-dollar firm and I want to sell to another multi-billion-dollar firm, that's when I would call Harris. But tell me, our listeners, when would it make sense to reach out to you?
Yeah, thanks. I appreciate that. I mean, you need to plan early, right? So if you're thinking about doing something strategic, particularly on the sell side, you want to make sure that you're lining up a team of advisors anywhere from 12 to 24 months before you actually act, right? Okay. Because you want to make sure that you're prepared. There's a lot of work that goes into that preparedness stage, right? And that takes time. So before you know it, you might be going to market, but you want to make sure that you're taking the time in advance to prepare. On the buy side, I'd say it really depends on when you want. Some firms have teams that are dedicated to M&A. And so they don't necessarily need outside help, but maybe they want someone to come in for their first deal, their second deal, to create a program, right, that makes sense for them, that's accretive to their business, because each RIA is its own snowflake. Yep. And so that's an appropriate time to bring us in to help design an M&A playbook for firms. And then on the capital side too, I mean, it's very difficult to get a deal done if you don't have the capital pre-financed, yes, pre-lined up. And so, bringing on the buy side, having a dedicated and committed capital source, you can never be too early on that.
I love it. Well, Harris, thank you so much for your time today. Thanks for being willing to kind of talk about what's going on in the industry and have some back and forth with me. For all of our listeners, Harris's contact information is in the show notes. And of course, you can find him on Dynasty's website as well. And then for those of you that have questions about Dynasty, be sure to check out the interview that Dynasty's CEO Cheryl Penny did with Michael Kitces on the Kitces Advisor Success podcast. Harris, thanks again for your time. And for all of our listeners, until next time, happy planning.
Thanks, Matt.